I mean, our allocations are actually structural in nature, Stephen. That's not a cop-out about what's going on in the short term, but we're not overweight at the moment. We're kind of neutral to equities as multi-asset investors. That's kind of a familiar parameter. But we just feel that it's just time to wait it out. Things feel very expensive. The Nasdaq is expensive. Listen, we have an allocation to the Nasdaq, and we'll take what we gained over the last few months. But everything feels expensive. And I think it's just time to wait it out rather than kind of engaging heavily in this market. As you say, there's this laundry list of problems, and interest rates and inflation, they haven't gone away. The debt ceiling's done. And I think there's a sense that actually the markets need to refocus again on inflation and rates. The US consumer is pretty ambivalent about rates. It kind of, inflation, kind of expects higher inflation now. And that's dangerous because that entrenches expectations. Once you actually, entrenches higher inflation itself, because obviously expectations lead to higher inflation. So I think that there is a big risk around that actually the price of money, the reaction function of the Fed, higher rates, that hasn't gone away and could actually get worse for the market. And I think Karen was talking about how, that AI tech trade started to fade in the latter half of last week. I think that could continue because if you think about it, long duration assets like technology stocks, they are the most sensitive to the price of money, to the prevailing discount rate. And if that discount rate starts to tick up because investors feel that actually the Fed isn't done after all, then we could have quite a sizable correction. So we're just a little bit cautious there in terms of the next few weeks and months.
Is liquidity a problem in the markets at the moment? Liquidity in the credit markets as well. At the moment, I'm hearing all kinds of horror stories about the lack of credit available for refinancing in various asset classes, both in the private and public markets as well. Do we need to carry on or refocus, as we did back in March, on the availability of credit and liquidity?
Well, credit markets are actually very tight at the moment. Spreads are tight for investment grade and high yield. And I think there's that long-standing mismatch between being able to invest in, say, ETF fund type structures that take advantage of tighter spreads, but then suddenly if investors take fright and they want to exit, say default rates are perceived to be going up, any downgrade to global growth expectations, that could see a flight, and then you could get a liquidity mismatch there. So I think that old problem has always been there. And I think from a more general perspective, spreads are just very tight. Everything is priced to perfection. And these credit markets haven't really been tested in that regard. So I'm just sort of generally cautious. I mean, obviously equities, you get far much better liquidity, but I'm generally cautious on credit as well. And I think there's, the fact is you can get nearly 5% on the US T-bill. So I don't really understand, in a way, why the massive enthusiasm for longer dated credit risk, why take on default risk, private credit, okay, if it's carefully structured, makes sense, but I think this sort of stampede into it for higher yields when, you're getting nearly 5% for minimal risk. And okay, you could argue, well, the debt ceiling wasn't minimal risk, but I think it was unthinkable that there was going to be a problem on that side. But, now that we're back to normal, this week on the debt ceiling, I think 5% without taking risk makes a lot of sense for investors.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.